Hi, I'm Jimmy. In this video, we're looking at Boeing stock, ticker symbol BA. This video is part of our Dow 30 analysis, where we're analyzing all 30 companies in the Dow Jones Industrial Average. The goal is to see which of these companies could be worth buying today, even though, broadly speaking, the stock market seems to be overvalued. I'll leave a link in the description below to all the companies we've completed so far. Okay, so first we're going to run through the basics of Boeing's business, and then we're going to look at to see if we can come up with a fair value for Boeing stock using discounted free cash flow. Okay, so let's jump right in. So Boeing breaks their business into four primary segments. Now this chart is based on their 2020 revenue, and let's face it, 2020 was an unusual year, especially for a company like Boeing, specifically around the problems that they had around the 737 and their 777 commercial airplanes, plus everything that happened with COVID. So that in the back of our mind, I think it makes sense to also look at a previous year that was slightly more normal than 2020 was. So this lower chart here, well, this is a chart of revenue based on their 2018 revenue. And as we can see, well, their commercial airline segment represents a much larger percentage than it does in 2020, which is one of their primary drivers. So that's why I think it's important to look back at these numbers. Now, just so we understand how these segments have changed through time, well, this is a chart of Boeing's revenue going back to 2003, and we've broken them out by each segment. And then clearly in recent years, well, the drastic drop in commercial airplanes, the drastic drop in the sales of commercial airplanes has really hurt their business. Now, on the bright side, people have begun to travel a lot more in 2021, and Boeing is expecting for revenue to ramp up in the coming years. Okay, now let's take a peek at a few other numbers that are important for Boeing. First, this is their dividend history. Now, Boeing's dividend were moving rapidly higher for many years. And then when the trouble really began, Boeing paused their dividend. Now, I actually think that the growth here was way too fast. The growth of dividends was way too fast, especially when we saw their revenue chart. The revenue chart wasn't growing nearly as much. So I think the pause in dividends actually turns out to be a good thing for Boeing. First of all, they got to save cash during the troubled times recently, but it also got to reset the whole growth thing. Now, analysts are expecting for growth or for dividends to reemerge sometime in 2022. I believe they're thinking the second or third quarter of 2022. Okay, now before we look at the fair value of Boeing stock, let's look quickly at Boeing's debt, because this has got an important factor in coming up with a fair value calculation. So this is a chart of Boeing's debt going back the past 10 years. Now, I'm using both short and long-term debt, but I'm just using the debt portion of the balance sheet. I'm not using the entire liability section of their balance sheet. Now, I bring this up because I recently saw an analysis of Boeing where the guy wanted to check what their debt was. He wanted to analyze how the debt has changed as Boeing has been through troubles with planes crashing and COVID happening and all of that stuff. And then what he did is he pulled up total liabilities. This is what the total liabilities look like. And he said, okay, he actually said, okay, debt has gone up a bit. So total liabilities, yes, have in fact gone up a bit. But there was no real red flag about the overall debt situation. Now, I'm guessing that's because this jump, the most recent jump in total liabilities, was about a 20% jump, which, yes, is a big jump, but it's not that big of a jump, especially when we consider everything that happened in 2020. And then he went on to say, let's have a peek at the quarterly numbers. So this is a chart of the quarterly numbers for total liabilities. And they said, okay, there's a jump in liabilities, but the trend is in the right direction. Look at total liabilities are in fact falling every quarter, which implies that they're paying off their debt. So we might even say that their debt situation is a positive sign considering everything that happened. But does debt tell the same story? So now when we switch back to the debt chart, this is short and long-term debt. Well, now we can see that debt actually jumped about 130%, which is a drastic difference from 20%. And if we overlay the past 4 quarters, which previously looked like a positive trend because it was heading lower, well, for debt, we can see that the trend doesn't look anywhere near the same. It started to head lower, then there was an increase in debt, which means they took on more debt, and then it did drop again after that. Now, I'm sure that some of you perceptive investors out there are saying, aren't debt and liabilities the same thing? And technically, yes, debt is a liability. But I would argue that not all liabilities are the same thing as debt. At least not specifically as we use it when we're coming up with the fair value of a company. And here's what I mean. Let's imagine that you lent me $10,000 for my company, and I have to make interest payments to you. And over the course of, we're going to make those interest payments over the course of, let's say, 5 years. And at the end of the 5 years, I got to pay back the principal. Well, what we just described is a bond. That is, in fact, debt. I've taken on debt for the company. But what if on the flip side of that, at the business, at the company, maybe we have a break room that people hang out in on their lunch or whatever it is. And in that break room, we're streaming Netflix, let's just say, or Disney Plus or whatever it is. We're streaming some sort of streaming service in there. Well, surely we have to pay for that Netflix account on a monthly basis. Well, let's pretend that we have to pay our Netflix bill tomorrow, but the quarter ends today. Well, that 10 or 15, 20 bucks, whatever Netflix cost us, will be on the balance sheet as a liability. This falls under accounts payable. Accounts payable is a liability, but surely we're not implying that the Netflix bill is in fact the same thing as the $10,000 that was lent to the business. Now we may say this sounds like a really minor difference. Well, here's why this is important. When we switch over to the discounted free cash flow calculation for Boeing stock, and by the way, if you're not sure how to do this, I got a link in the description below to a video as to how to do this whole thing. Created an Excel template, I'll send that to you, whatever. But basically, what we do is we take analyst estimates for free cash flow and we discount those back to today. And that gives us a fair value of the total company. We then adjust that fair value of the entire company for net debt. So debt minus cash. And when I'm saying debt, I'm talking about the debt, the 60 billion that, or the original chart that I pointed out. We adjust the fair value of the company by that amount. That gives us the value of the stock. In this case, it turns out to be about $212 per share. But this is why it's crucial that we use debt and not total liabilities, outside of what I've already said. So this adjustment, like I mentioned, this is the adjustment for debt. This is how much the value should drop because of debt. That adjustment assumes that, hypothetically, if we were taking control of the company, well, we would pay off all of their debt. So we take any cash we have, we pay off their debt, and then how much is remaining after all the debt is paid off. But also, if we use total liabilities, well, we would be double counting many of those liabilities. Here's what I mean. So in order to get free cash flow, basically what we do is we take cash flow from operations and we subtract capital expenditures. Capital expenditures is sort of like business upgrades that are necessary to keep the business going. Cash flow from operations already includes the expenses, things like Netflix that we mentioned before. All of the expenses, the operating expenses, are included in cash flow from operations. So we can't use total liabilities and assume that is the same thing as debt. It is not the same thing. When analysts make free cash flow projections, or if you and I were to make free cash flow projections, generally we're going to assume that debt will remain the same, unless we have some reason to believe it won't. But either way, that's why we want to use debt and not total liabilities. It's important that we don't confuse the two. Okay, with that being said, well, it looks like Boeing stock is worth about $212 per share. Right now, it's trading at about $240 per share. So in my mind, the stock seems overvalued at this point. Now, I generally like to add a margin of safety to a purchase. And a stock like Boeing is certainly going to need a margin of safety because, as they have proven in recent years, a lot can go wrong with this company. I'd probably be looking to add about a 20% or so margin of safety to this one. Now, if you're not sure how to read a balance sheet, I actually did a video a while back where I walked through a lot of the important line items on a balance sheet, explain how they can be used. So if you're curious, perhaps that's a good next video for you to watch. I get a link right here. I get a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.